this edition of Search for Yields, I'm going to talk about how issuers of bonds increase the capital protection of the bonds for investors. I'm Arjun Patsati, INR Bonds. And why do issuers want to increase capital protection for investors? One is because the issuer themselves may be of weaker financial nature. They may have lower credit rating, and because of this, investors could be uncomfortable to invest in these bonds, or they could also want demand higher interest rate to compensate for the risk they're taking on issuer or investing in these weaker uh, credit profile bond companies who issue the bonds. So how do these companies, issuers, provide increased capital protection for investors? Now, there are many ways to do that. One is you have an internal and external factors. So on the internal side, they could offer more collateral. So if supposing they are borrowing 100 rupees, they could offer collateral worth 250 rupees or 300 rupees, right? The other is through something like seniority of the debt. That means if anything happens to the company, the bondholder will have the first right to all the liquidation proceeds of the issuer. There are external factors also, how companies increase capital protection. One is by getting a guarantee for the bonds. Now, I'll talk about guarantees as we go along. The second is through, say, an insurance. Now, the government of India has floated this concept of insurance protected bonds, where insurers actually protect the investor from default, and in turn, the issuer pays some premium to the insurance. Now, this has not come out yet, but there is a definite policy and thrust to this kind of a bond issuance. And this is especially good for infrastructure companies. And then you have cash itself. So many companies deposit cash in an escrow account with the trustee. And if there is any shortfall, where they could pay, if they have to pay an interest or a principal, then the trustee dips into this cash and then gives it back to the investor. So what are the types of this protect capital, increased protection, capital protection for investors? What are the types of bonds? So you have guaranteed bonds, like I said, and these guarantees could be by government, external agencies, by promoter groups. So you have, for example, you could have ADB, Asian Development Bank, or IFC, International Financial Corporation, or World Bank. Many of these can actually guarantee bonds. You could have global banks guaranteeing or domestic banks guaranteeing the bonds. You could have government. So in India, you have the central government guaranteeing bonds, for example, of MTNL and Air India. And you have state government guaranteeing bonds, and the state government guaranteed bonds are plenty in circulation. You have promoter groups guaranteeing bonds. For example, you have Hero. You could have groups like very large groups like Hero, etc. Guaranteeing bonds of some of their subsidiary companies, such like. So these guarantees provide comfort to investors that even though the issuer is weak, issuer financials are weak, their principal is protected, and they will get their money back along with interest regularly because of the guarantees itself by a very strong backer behind them. Then you have structured bonds like covered bonds. So the covered bonds are basically bonds that are covered with collaterals. So the collaterals could be anything in the form of real estate. It could be in form of even cash, etc. So these are called covered bonds. Then you could have securitized bonds. So you have bonds where companies carve out a pool of assets and and sell those assets, which are completely risk free from the company itself. So they don't carry the risk of the issuer. They don't carry the risk of the company that is originated the assets. They only carry the they only uh, carry the risk of the assets itself. So supposing it's a pool of receivables, say a rent, or it could be contracts, etc. Then or it could be loans. Then only the risk of the loans defaulting is the what the investor carries. And with all these pools are rated by rating agencies, and they do a lot of due diligence on these pools. So that is one way, and obviously cash collaterals and increased cash collaterals, and also pledge of equity. So what you call loan against shares. So bonds could be issued with loan against shares. These have got its plus and minuses, and how all the kind of legalities that come with it, etc. But these are some of the ways capital can be protected. And then you have these market-linked debentures, which MLDs, and these are finding a lot of favor with ultra-high net worth investors because of the structure, which could give them a tax benefit. These MLDs are typically linked to some market instrument, and they claim to have principal protection but not guarantee. So the principal is protected, but they still carry the credit risk of the issuer. And the principal is protected due to with some various use of market link structures. Some of them you could use options, some of them could use other derivatives, or it could just be that it could be protected by any one of the above protection measures which we spoke about, like cash collateral and over collateralization, etc. So these are called MLDs, and they are being very popular in the market as well. So these are some of the means by which issuers can increase the capital protection for investors. As far as investors are concerned, they must understand if it's a guaranteed bond, who's guaranteeing it, and their ability to pay, the sanctity of guarantee. So their advisor, or even who is that, if it's an institution, they would get their lawyers to look at the whole guarantee structure, etc. Then you have the structures. So if it's a structured bond, then you'll have to see how the collateral is, what is the status of the collateral, and can they be liquidated easily. So many of these kinds of due diligence have to be done. So all this is definitely some due diligence have to be done by the investors themselves before investing in capital protected bonds with higher capital bonds with higher capital protection, because one is they are also getting a lower interest rate due to the capital protection, and the second is that they should not take it for granted that the whole capital protection can work seamlessly without any issues. So that's it for this edition of Search for Yields, and please do visit INR bonds and look at QuickInvest for all kinds of bonds, including capital protected bonds. QuickInvest gives you a curated list of bonds, but what's more important is we give you all the information that you need to take to invest in these bonds. So if they are capital protected, we tell you exactly what is the risk in the, despite the capital protection, we tell you it's what the risk is in the bonds, exactly what the risk is in the bonds, for you to take your own investment decision. Thank you very much.